What's up, everybody? My name is Joe Brown. This is Heresy Financial. By the looks of it, we are now entering the melt up, the blow off top, the crack up boom. And so today in this video, I'm going to tell you, number one, what that means, what I'm talking about. Number two, why we are experiencing this melt up, crack up boom right now at this stage in the game, and why that is normally the last stage before you get to a crash, to a sell off, and the mechanics, the reasonings behind those things happening. Because stocks just hit all-time highs, but it's not going to last forever. Ready? Let's dive in. All right, so we are going to look at three things going on right now that show that what is happening right now in stocks is the blow off top. It is a crack up boom or a melt up. It's not just strong, robust economic growth. It's not just business as usual, just stocks growing along. We are going to look at three things that show what I'm talking about here. The first thing we're going to look at is something called breadth. If you're not familiar with what breadth is, it just means how many of the stocks in the index are participating in the performance that's causing that average performance to happen. So right here you see the S&P 500 breaking out to all-time highs. Very similar performance recently with the NASDAQ and with the Dow Jones, and similar, although not quite as extreme, with the Russell 2000. Despite these indexes being at or near all-time highs, this performance is not being shared by most of the stocks in the index. Right now, stocks that are a part of the NASDAQ, only 31% of the stocks in this index are trading above their 200-day simple moving average. For the Russell 2000, that number is 36%. Only 36% of stocks in the Russell 2000 are trading above their 200-day moving average. Now, the S&P 500, you can see, has been performing the best out of all, so you'd expect that the breadth would be a little bit better, and it is, and about 68% of the stocks are trading above their 200-day moving average in the S&P 500. However, if you look at just five stocks, Apple, Microsoft, Nvidia, Tesla, and Google, they have, just those five stocks alone, have accounted for over half of the S&P 500's performance since April. What this shows is that we are not in a period of time right now where you have broad economic strength and growth that's being experienced by all. Instead, you have a few players that have such outsized performance that it skews the averages and makes the average look really good, when in fact most participants are experiencing lackluster performance, decline, not growth, or potentially bear markets. And there are a lot of stocks, especially in the NASDAQ, that have been deep in bear market territory for months now. This has led some to say the stock market crash already started a while ago, it just hasn't hit the averages yet. So a lack of breadth is red flag number one when determining, is this stock market growth that we've been experiencing, is this something that is sustainable, or is this kind of like a blow off top that's going to result in pain? So that's red flag number one. The second thing that we are going to look at is the Fed tapering. And I know so many people, for some reason, still don't think the Fed is tapering. When they started tapering in November, how much did they purchase? How much did the Federal Reserve add to their balance sheet in the month of November? Well, turns out it was $75 billion. That's a little bit less than the $120 billion that they were doing on average for the 15 months prior. Looks like a taper to me, and all the images from last week of the Federal Reserve's balance sheet increasing by a lot during that 1 week made all the rounds on financial Twitter and everywhere else. Guess what? The Federal Reserve doesn't buy or sell the same amount every single week. And so what are we going to see by the end of December? We're going to see probably about $75 billion net added to their balance sheet for the month of December, just like the month of November. And guess what? In January, they're going to purchase even less. Tapering doesn't mean selling. Tapering means reducing the amount that they're purchasing. So their balance sheet was increasing before at $120 billion a month. November and December, it will be increasing less. November, it increased at $75 billion, and it will go down until they stop purchasing in March again, unless everything starts to collapse, in which case they'll reverse course. But the taper is on. That's the most important thing. So while we're having stock market averages slamming up to all-time highs while we're having used car prices breaking records, increasing. They're growing faster than Bitcoin. You get better performance this year out of your used cars than you do from Bitcoin. Meanwhile, the Federal Reserve is pulling back on the easy money train. They're making it more difficult to get your hands on money. They're trying to push small amounts of disinflationary or deflationary pressures onto the market as everything is on its last steam, on its last little drop of gas, exploding up to all-time highs. So the taper is on, the taper is happening, and that is happening while we have stocks hitting all-time highs, which is why it is red flag number 2. And then finally, the third thing that we are going to look at here is leverage and interest rates. Obviously, interest rates have been increasing. When you have a big buyer of bonds start to pull out of the market and start purchasing fewer bonds than they were purchasing before. When you have somebody who has an appetite, the federal government, appetite for debt, they want to borrow more and more and more, you are going to have, all else being equal, rates will start to increase. And that's exactly what we've seen, especially short-term rates are going higher and higher and higher. This is happening despite the fact that we have the most over-leveraged global financial system in history, and that's not counting derivatives. That's just looking at the debt. Massively over-leveraged on the backs of the lowest interest rates in history. Most of that debt is only there because it's being rolled over. That means they're paying off old debt by taking on new debt. What happens when that new debt gets more expensive? Well, either you need more cash flow to service that new debt for that higher interest rate, or you can't roll over as much of the debt. You have to pay some of it off, which is deflationary, because when you pay off debt, that destroys money, just like taking out new debt creates money. Less money floating around the system puts downward pressure on prices because there's less money in the system compared to all the stuff, which means money becomes more valuable to the stuff. Said another way, stuff gets cheaper, including assets, including goods, including services. Not to mention the fact that if you tighten too quickly, rates go up too quickly, somebody overnight becomes insolvent. There's bankruptcy that has trickle over effects. A domino effect starts to happen. You could very easily spark a catastrophe in the global financial system that obviously central bankers won't allow. They will paper it over. But meanwhile, what we're seeing is asset prices exploding while all three of these big red flags are being waved. We're seeing leverage all-time highs while rates are increasing. We're seeing the taper actually take place in real time. And if you don't believe me, go add up for yourself. Go look at the Federal Reserve's balance sheet and look at what they do every single month. The taper's happening. And then finally, breadth. All of the performance is concentrated in just a few positions, whereas most positions are below their 200-day moving average. That means they haven't been growing, they've been declining, and some are steep in bear market territory, meaning that the stock market crash has already started in places. It just hasn't made its way to being showing up in the averages yet. And that's why it looks to me like this is the melt up, this is the blow off top, this is the crack up boom, and it ends as a result of the tightening that must take place after the artificial monetary expansion in order to stop hyperinflation from setting in. But we all know that as it starts to crash, who knows whether that's 5%, 10%, 15%, 20% or more, at some point the economic pain always becomes too much and they step in and they stop the crash, they soften the blow, they print money, they bail out the economy, and that'll be a story for another time when that starts to happen. But as for now, things are going up. They're going to start to crash at some point, whether that's in a couple of weeks or a couple of months. Sometime in 22 is when I think. Who knows? But right now, this looks to me like the melt up. And finally, if you're still there, I want to let you guys know I'm going to be in Denver on January 8th. If you are able to come, I would love to see you there. It's going to be myself, the Economic Ninja, plenty of others. We're just going to have a meet and greet, very low key. It's not going to cost anything. We don't have a location nailed down yet, but it will be within 1 mile of Union Station in Denver, Colorado. 5 p.m. on January 8th in Denver. I'd love to see you there. If you plan on showing up, again, it doesn't cost anything. Please sign up with the link I have in the description below. We're just trying to get an accurate head count there so that we can reserve a spot that has enough room for everybody. Would love to see you there. Sign up in the link below. It's on January 8th in Denver. As always, really appreciate you guys. Thank you so much for watching. Have a great day.